If you're a small business owner or independent contractor that's trying to maximize the Roth Solo 401k, there is a problem that you're most likely going to run into, and you're going to be upset and disappointed because you can't maximize your Roth Solo 401k. But luckily, there is a solution. You do have options. You just need to know what those are in advance. What's going on, guys? Welcome back to the channel. Or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle. So let's go over what I'm talking about. What I'm talking about is the mega backdoor Roth IRA or Roth Solo 401k. And we want to maximize it. So we want to get as much money in after-tax dollars into the Roth side. But there's going to be a problem if you have or open a solo 401k. And I'm going to explain it. Now, I didn't go through every single plan in the country. There's probably plans that you can sign up for that might be able to accomplish this right off the bat. But for most people, most individuals that are trying to open up these accounts, this is a problem that you're going to run into, and you might not be aware of it until you go ahead and try to execute on the Roth transaction. So let's talk about what the mega backdoor Roth is really briefly, just so you can kind of get a base of where we're at. And then I'm going to show you what that fix is so you can make sure that you can get as much money as possible and you can plan correctly. So let's go ahead and pull up this illustration really quickly right here. And what I've drawn out is the solo traditional 401k, the solo Roth 401k. We have a traditional IRA and the Roth IRA. So what you're probably familiar with is a traditional 401k. For the solo, you can do up to $19,500 as the employee. That's not a problem. If you're an S Corp, you can do 25% of your compensation, your W-2, or you can do 20% of your net profit minus 1/2 of your self-employment. So that's going to be the maximum you're going to be able to get in here. And for 2021, that's a maximum, and I'll just write it up here, of $58,000 that we can put into this solo 401k for you. And if you have a spouse, you might be eligible to have a spousal solo 401k, and you can also contribute an additional $58,000. But the same rules apply. If your spouse works for your business, it's still 25% of their compensation if they're a W-2, or of course, if you're splitting up the Schedule C income. So the traditional 401k, we can put that in there pre-tax, and we can also make a profit sharing contribution in addition to that up to $58,000. But again, the problem here is the 25%. So you want to keep your income as low as possible, pay yourself that reasonable wage. If you're an S corporation, obviously if this is net profit, all of it is included. But the name of the game here is to get as much money into that traditional side pre-tax and then give yourself some options. So that's really step number one that you're going to take a look at. So if that's the case, we're going to put that in there. But the problem that you're probably already thinking is that you have to have your compensation significantly higher in order to get the maximum amount. So if you're an S corporation, it's $154,000 is the maximum. 25% of that plus the 19.5 is going to get you to the 58. But what if you're not at 154? What if it's less? Is there another way to get that money in there? So right now, I've just described how you can get the 19.5 plus your 20% or your 25%, depending on how your filing status is, into the traditional side. But if you want to get more money in there with a lower income, you have another option, and that is the non-deductible contribution. You're thinking, well, I already know about the non-deductible contribution. There's a problem here. So we can put in the non-deductible contribution by having significantly lower income. In this case, you can almost have $58,000 because you can make that non-deductible contribution dollar for dollar. There's not a percentage. So you don't have to have $154,000 in income in order to maximize your solo 401ks in that instance. But the problem is most plans don't allow for those non-deductible contributions. So you have another problem as well. Most of these plans, these prototype plans, ones that you can just call up the broker dealer and say, I want a solo 401k. They're like, here you go. It's free to open, free to have. Here you go. And you open it up and you can't do a Roth conversion. So the first scenario that I described, again, we'll look at it again, going from the traditional 401k over to the Roth 401k, that's the Roth conversion. Most of these plans, you can't do the Roth conversion. They don't allow you to do it. Even though you can do it by law, in the solo 401k, the plan documents have to allow for it, and most of these do not have it. And I think it has to do with a simplified plan that's basically cheaper to go out and get approved by the IRS. So it's just a quick and easy way to put out a plan, and it doesn't have that Roth conversion option. The other thing it doesn't have is the non-deductible. So those are the two ways in order to maximize the Roth side. Now, the reason is because you can only put in 19.5 into the Roth. That's it. You can't put an employer contribution into the Roth side. That has to go into your traditional side. So there's no way to get additional dollars into this plan. You're running into two different basically brick walls with the Roth conversion and not being able to make those non-deductible contributions. So what can you do? If you have a high compensation, you can contribute more dollars into the traditional side, but you still can't do the Roth conversion. So here's what you're gonna need to do. You're gonna need to put those pre-tax dollars into the traditional side, assuming that you have a higher income, and then you can do a transfer of those dollars into your traditional IRA and then do the conversion. That would work. So that's option number one, where you can put the money in, but you need to have that higher income. But if you don't have the income to support it, and there's two problems with that. If you're an S corporation and you're using the S corporation to lower that self-employment tax, well, then you're kind of defeating the purpose, because now you're going in the complete opposite direction and you're going to need to be over that Social Security threshold, so you're not really saving anything here. So that option might not be as appealing to you. So the second option would be to have your own plan documents. Now, this really depends on your particular situation and whether or not that cost makes sense, because it is usually several $100s at least in order to get the plan documents. Then you got to get it implemented, and that is going to be your plan document, so you have a little bit more responsibility here, but now you can open up to do the Roth conversion and the non-deductible contribution. So while it might be confusing to hear that you can make non-deductible contributions to a solo 401k and that you can do Roth conversions to maximize the Roth side and just maximize your contributions into your retirement plan, it depends on the plan document. So it's really important. And you can call around to all the broker dealers. It's likely that you're going to find that most of them, or if not all of the ones that you're going to call, are going to have this roadblock. So you have to get your own plan documents in place in order to do this. Now, you could wait until the last second, but the problem that you're going to run into, like most small business owners that wait until the last second to do their taxes, to make these contributions, is that you got to get the documents, you got to get them submitted, you got to take your current plan, you got to convert it. So you need to have your ducks in a row before you do this transaction, or you might run out of time. So you have to do it. Now, you can do these transactions all the way up to when you file your taxes, including extensions. But like I just said, as a small business owner, you probably wait, like I do, at the last minute to do just about everything. So you want to keep this in the back of your mind. If your objective is to pay yourself as little as possible, get as much money into your retirement plans as possible, you just need to be aware of this issue with your solo 401k. If you're maximizing your Roth side, and even if you're maximizing the other side, you really still want to take a look at that same thing. Unless your total objective is to say, I want pre-tax dollars into this retirement plan, then you can just pay yourself a higher wage and put it into the traditional side and then go from there. So that is really the fix for the solo 401k if you're trying to maximize the Roth side. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.